You've probably heard that accounting is the universal language of business. And, like any language, it has rules. It has a grammar that makes sure everyone, everywhere, is on the same page. Today, we're going to break down that grammar, those core principles that stop finance from becoming total chaos.
I mean, just imagine this for a second. What if you handed your company's financial records to 5 different accountants and they all came back with 5 completely different profit numbers? It would be absolute chaos, right? How could anyone, an investor, a bank, even you, make a smart decision? That's the exact problem we need to solve.
And thankfully, we have a solution for that chaos. It's a universal rulebook called Generally Accepted Accounting Principles, or GAAP for short. Just think of it as the official dictionary and grammar guide for the language of business. It's the framework that ensures everybody is playing by the same rules.
So, here's our game plan. We'll start with the ground rules, the who and the what of accounting. Then we'll get into the when, how we measure things over time. After that, we'll look at some principles of prudence, which are kind of like the guardrails. And finally, we'll tie it all together to see how these rules make financial info something you can actually use.
All right, let's dive right in. Before you can start measuring anything, you have to know 2 very basic things. Who exactly are we measuring, and what is it that we're allowed to measure?
So, the first and maybe the most fundamental rule is what we call the entity concept. It's super simple, but incredibly important. The business is its own legal person. It is totally separate from its owner. The company's bank account is not the owner's personal piggy bank. Every single transaction belongs to the business, and only the business. Okay, let's make this real. Take a look at this example with Mr. X's business. Initially, he puts in $700,000. That money becomes the business's assets. But notice, it's also listed as capital, which is money the business now owes back to Mr. X. Now watch what happens when he takes out $5,000 for himself. It's not a business expense. Instead, the business's assets go down, and the amount the business owes him, the capital, also goes down by $5,000. See? Perfectly separate.
Okay, so that's the who. Next up is the what. This is the money measurement concept. And the rule is simple. We only record things that we can put a clear, stable price tag on. A company could have the most incredible team spirit and morale in the world, and that's super valuable. But you can't reliably measure morale in dollars and cents, so it doesn't go on the books. Only things we can count in currency make the cut.
So we've got the who and the what figured out. The next obvious question is, when? How do we handle the dimension of time when we're trying to measure performance?
A business is supposed to have a super long, maybe even endless life. But it's not very helpful to wait until the very end of it all to find out if you were profitable. So the periodicity concept fixes this. We just chop up that long life into regular, bite-sized pieces, usually a year. It's kind of like checking your lap times in a race, instead of only finding out how you did after you've crossed the finish line.
Now this next one is a huge deal. The accrual concept is a real game changer. It says we have to record things when they actually happen, not just when cash moves around. So you record revenue the moment you've earned it, like when you deliver a product, even if the customer is going to pay you next month. And on the flip side, you record an expense as soon as you use a service, even if you haven't paid the bill yet.
And this is why it matters so much. Let's put these 2 methods head to head. With the cash basis, you only count money when it's literally in your hand. But that can be really misleading. A company could be making tons of sales, but look unprofitable just because clients are slow to pay. The accrual basis, though, gives you a much truer picture of how the business is actually doing during that specific period.
And that leads us perfectly into the next big idea, the matching concept. You can think of this as the real engine that calculates profit. It's a simple but really powerful idea. To get the true profit for a period, you have to take the revenues you earned and match them with the exact expenses that helped you earn them. So, the profit equation gets a little more specific. It isn't just revenue minus expenses. It's the revenue you earned in a period minus only the costs that were directly related to that specific revenue. So, if you produced 1,000 shirts but only sold 800 this year, you only get to subtract the cost of those 800 shirts when you're calculating this year's profit. Make sense, right?
Okay, we've got the core mechanics down. Now let's talk about a set of principles that add a layer of caution and good judgment to the mix. These are the essential guardrails that keep everything on the straight and narrow.
First up is the going concern concept. This is a big one. It's the basic assumption that the business is going to keep on running for the foreseeable future. We're not planning on shutting down and selling everything tomorrow. And that's exactly why we can list a factory on the books at its original cost, not what we could get for it in a fire sale. We assume it's going to keep creating value.
This quote right here perfectly sums up the next principle, conservatism. It's all about being prudent and cautious. Basically, if there's a decent chance you might face a loss, you need to account for it right now. But if you think you might make a big profit in the future, you have to wait until you've actually got it locked down. In other words, plan for losses, but don't count your gains before they hatch.
And finally, we have the consistency concept. This is pretty much common sense. It just means a company has to pick an accounting method and stick with it year after year. And why is that so important? Well, it's all about comparability. It stops a company from, say, changing how it values its inventory just to make profits look a little better one year. It ensures we're always comparing apples to apples. So we've gone through a lot of different rules and concepts, and you might be thinking, why all the fuss? Well, it's because they all work together for one ultimate goal: to make financial reports genuinely useful. This is the big payoff.
The whole point of the entity concept, the accrual concept, all of them is to make sure the final product, those financial statements, have certain key qualities that actually give them value.
And here are the 4 big ones. First, is it relevant? Does this information actually help you make a decision? Second, is it reliable? Can you trust it to be accurate and free from bias? Third, is it comparable? Can you use it to see how this year stacks up against last year or against a competitor? And finally, is it understandable? Can a reasonably smart person actually make sense of it?
And that brings us full circle. All these rules work together to solve that accounting anarchy problem we started with. They create one common, trusted language that turns a mess of raw data into clear, reliable information that people can actually use to make important decisions.
So we've explored the rulebook that modern finance is built on. It creates structure, it creates clarity, and it creates trust. But that leads to one last, very interesting question. Now that you know the rules, what happens when people decide to bend them? Well, that's a story for another day.